We're going to do a worldwide economic tour. If you have your event pads, we want some opinions. And if you took a different seat and have a different event pad and you want to log out and log in, did I get it right, Leanne? I think I got it right. Okay, here we go. This is a worldwide economic tour, and I will ask Mike McKee soon to introduce a distinguished panel that has traveled from afar and more afar. But before that, we have 3 questions for them and for us. Here we go. The U.S. economy is recovering slowly over the next 12 months. It will. This is your opinions, please. A, continue to recover slowly. B, pick up the pace and become more robust. C, weaken but continue recovery. And D, go into recession. One of the 4 choices, please. Well, we have a very strong opinion in one place. We'll let you gentlemen, yes. Okay, let's get to this next question. The strongest economic region in the world is North America, Europe, Asia, including China. I don't know. Well, I don't know what that means, but our panel will help us figure that out. And the last question, we'll have a little fun. Economic forecasts by professional economists are. Now we have 4 of them sitting right here. A, reliable and can be depended upon, and anyone who votes for that doesn't have to come back next year. Reliable and can be depended upon. B, way off the mark and unreliable. C, sometimes they get close but not always. And D, they are so bad I don't look at them. Okay, interesting response. All right, we're going to do a tour of the world, look at the economics around the globe. Mike McKee, these 4 gentlemen are all yours.
Thank you very much, David. I think, a quick story about David, I think most of you don't realize, he always wanted to be an opera singer. And tonight at the Wart Bar at about midnight, maybe we can all vote on that tonight. Well, so here we are, the last panel of the day, the 5 of us, all that stands between you and having drinks and driving a Rolls Royce. You should probably do that in the opposite order. But given that, I'll make this very short. You know the speakers, their bios are in the program, so I won't introduce them in depth, beyond noting that we have Don Rissmiller, Kozo Koide, Henry Moe, and Michael Drury. Given Michael's new role with the GIC, it's probably very important that he impress you. So I'll save him for last. That way, if we do run over and keep you from the drinks, you'll know exactly who to complain to and who to complain about at the same time. Maximizing efficiency is what economics is all about. Topic is the best way to conclude this terrific program, I think, though, because you've had great advice all day about the to-dos, the how-to-dos, the what-to-dos, the what to watch out for. But I'll tell you a little story. I sat with Tim Geithner once when he was the president of the New York Federal Reserve. We went through all the problems that the Fed and the economy faced, and this was after Bear Stearns, but before Lehman Brothers. I've known Tim for a very long time, and I turned to him and I said, Tim, of all those things that are on your plate, what scares you the most? And he said, none of them. He said, what scares me the most, what I worry about the most is what I don't know. What's out there that I don't know about? And that is perhaps always the biggest challenge for all of us, and particularly for you. What might happen in your business that you're not thinking about that will force you to adapt and change plans? Well, we have this distinguished panel here to take on that question, let you know what's going on around the world, what to look at. Hopefully, at the end, you'll know more, and there will be a few things more that you don't have to worry about not knowing something about. And we'll start with Don Risno. Don?
Thank you very much, Mike. I appreciate the chance to be here. I appreciate all the sponsors that have made this event possible. I've been asked to talk about the U.S. business cycle and where we're at today, where we think we'll be going in the future. Business cycles are at inflection points when they're most interesting. And I think based on what we've seen today, there are a number of reasons to suspect that right now we're thinking about an inflection point. And one of the key items is monetary policy. And so if we think back, say 5 years or so, the Fed and other central banks had a job that was conceptually not that hard, but technically very difficult. So when you have a crisis, just about all the literature says the same thing, which is you're supposed to ease a lot. So conceptually, it's not that hard. It's technically very difficult because when you have a crisis, all the plumbing is broken. So you spend your late nights coming up with new acronyms. So if we think back, it was the CPFF and the MMMF and the TAF and TALF and QE. There's a lot of effort put into coming up with new acronyms. Today, the inflection point is I'd say that's switched. The tools to tighten, when we're at that phase of the cycle, have been established. They're being finalized. If we think about the reverse repos or the interest on excess reserves, they're being tested. They're out there. We've come up with our acronyms, RRPs and these type of things. So it's technically easy, but conceptually very difficult. A lot of the questions in the presentations were about when to use them. So previously, we had a conceptually simple but technically hard job. Now we have a technically easy but conceptually very difficult job. And so what that gives rise to is a number of items that seem like they all can't be right at the same time. So right now, if we think about what just happened in the first quarter, in the US data, you had a large contraction in growth. Most economists seem to expect a bounce back in growth. I think that's right. So you have economists expecting growth to pick back up, especially in the US. Then you have talk of Fed tightening sometime in the future. Bouncing growth, Fed tightening. Yet you have 10-year Treasury yields that are quite low. So who's wrong? Is it that growth won't bounce? Is it that the Fed won't tighten? Or is it that bond yields need to adjust? And so I hope by talking about parts of the business cycle, we can give some information on this. And so to look at the business cycle, we'll pull up a chart of GDP here. And what I would first note is that there's a reasonably consistent historical cycle. Around 1982 or so, there's a notable statistical break where volatility changed some. And so you were more volatile in the past, you've been less volatile in recent cycles, and in particular, in the last 3 business cycles, somewhere towards the middle of the cycle, you got a slowdown that wasn't a recession. So if you look at those boxes here, these periods correspond to periods that we think could be similar to what we just went through. Slowdowns that were not recessions. So the periods here we're looking at are roughly 1986, 1996, and 2006. Now, when we think about what comes next, there are a few items that we have to focus on. One issue is those mid-cycle periods are also the period where the labor share of GDP turns around. In other words, if we think of the mid-cycle period as the split between the first half and the second half of the business cycle, then one way to mark this is to look at labor share of income, labor share of GDP. So this is corporate compensation as a share of corporate GDP, or basically labor share of what is going on. Now, this also is a pretty autocorrelated chart, so doesn't bounce around that much. Really has two main business cycle moves. Labor share of GDP starts a cycle falling, ends a cycle rising. And that pattern has been consistent, even though we've had a trajectory that's been down for quite some time. Still, even though you're making lower highs and lower lows, you have a business cycle pattern where you start a cycle with a falling labor share of GDP and end a cycle with a rising labor share of GDP. And so if we've just come through our mid-cycle point, we are now at a point where labor share of GDP should start to rise if we're in the second half of the business cycle. So my answer is, we are in the second half of this business cycle. We're at the point in this cycle where cost cutting is going to stop working. Early in a cycle, cost cutting is how you get profits up. Later in a cycle, you need ways to make the pie bigger. And I would say this is why our first panel was so interesting and perhaps so long. Because we are all looking for that next source of productivity. In the second half of a business cycle, what becomes very important is a way to make the pie bigger. The way you make the pie bigger is you get productivity up. You need to pay labor and capital together in the second half of a business cycle. Productivity becomes very important. Now, that downtrend that you see has been well studied. It's generally attributed to things like globalization or technology, and we could spend a long time on that. I don't think it's as interesting at this point, though. If what we're interested in is the inflection point, I'm less concerned about whether we go back to where we were in the 1970s on labor share of GDP than I am about whether it's going up. Because once it starts to move in one direction, it tends to keep moving. That momentum is what we're focused on here. Another place we see this is in average hourly earnings for non-supervisory workers. There have been a number of questions about the labor market. How's the labor market working? Are we tight? Do we have slack? Those type of questions. So one way to think about this might be to go backwards, which is let's look at what wage growth is doing, and from that infer whether we are tight or not in the labor market. So this is not the only series of wage growth. It may not even be some folks' favorite series of wage growth. There's some good series on compensation per hour that are broader, for instance. The problem is they're not quite as timely. So there are trade-offs within the data when looking at wage growth. There's also a new version of this series that is broader. So usually broader is better. However, when we're looking at a narrow piece of wage growth that's average hourly earnings, I might argue that it's more interesting to look at the average hourly earnings of those workers who make hourly wages than to try and broaden the definition in a different direction. Now, what we see from this chart is a couple things. One, wage growth is not fast. So if we say what type of number on this series, average hourly earnings, would be fast wage growth, you might come up with an answer about 4. You say, where was wage growth before the last several recessions? What type of wage growth hurts corporate profits? You get a number around 4. So wage growth is not fast. However, wage growth also has a lot of momentum to it. Once wage growth starts accelerating, and this chart has a longer history than some of the other newer series, you can see that historically, once this chart turns up, it tends to keep going up until it gets to 4 in the second half of a business cycle. And I say the reason is the unemployment rate in the US very rarely goes flat year after year. Think about what that would mean to keep the unemployment rate the same number year after year after year. It would mean that just because somebody decides to major in chemistry, 4 years later, 95% of them get chemistry jobs, something of that sort. And we know that's not really how the labor market works. There's a lot of people who change jobs many, many times, as we saw earlier this morning. And we think that's a good thing. But it also means the unemployment rate is an extremely smooth series, does not bounce around a lot. The unemployment rate doesn't go flat, goes up in recession, spends the rest of the business cycle coming down. And so again, with that momentum, the history of this series tells us if we started to go up, your guess for where we're going to be over the next several years is probably up even higher. Just as we'd say with the unemployment rate, unless we have a business cycle event, we're going to be looking at an unemployment rate that keeps coming down. It's a very reasonable prediction, we would say. So wage growth, remember we're trying to go backwards here on the labor market. What is the price of labor telling us? It's telling us wage growth is not terribly fast, but it's going up. And so I think this helps comment on the slack issue in the labor market. And so it's consistent with being in the second half of a business cycle. Another data point in that direction. Just click forward here. Now, there are three different views of the labor market that I'd say have come up today. One is the massive excess slack view, and it usually involves some version of this chart, which is your chart. That's a broader measure of unemployment. This is when you add in your marginally attached part-time for economic reasons, these type of numbers. You get an unemployment rate that looks a little different than the headline unemployment rate. Certainly the scale is different. So that's one view, is that there's extreme slack because there's a lot of discouraged workers that could come back. There are people who are working part-time who could take full-time jobs and so on. Then there's the headline unemployment rate, which we said was the U3 before. And then there's the short versus long-term unemployment rate argument, where the argument is that if you look at the unemployment rate for folks that have been unemployed 6 months or less, that's below its historical average, whereas if you look at long-term unemployment, it's way above. So the argument there is if you're long-term unemployed, maybe you are lacking skills to get back in to the labor market, in which case maybe the labor market could actually be tight. And I'd say if we go backwards and just look at wage growth, if the extreme slack argument was correct, if it was just U6, well, why are wages going up at all? And if the short-term unemployment rate number is correct, why is wage growth not fast? Say 4%. Why is it only 2%? And so what I think this does is it sandwiches you down to a middle view, which coincidentally might push you to the headline unemployment rate. In other words, if labor force participation is not that far off, maybe you wind up somewhere in the middle of these two views. The extreme slack view, the U6 view isn't quite right, but neither is the short-term unemployment rate view. You get sandwiched back to that headline unemployment rate by thinking about it this way. And so if you look at the headline unemployment rate, it's starting to get more normal. And this is why I think we're starting to talk about policy normalization, at least in the US. In Europe, we could say we're quite a ways away. If you look at European unemployment rates, they do not look like US unemployment rates. If you look at the ECB's policy reaction, it's getting more aggressive. And if we think about deflation risk in Europe, it seems higher than it does in the US, where you have some of these wage series and inflation series turning back up. But headline unemployment suggests we're maturing in this business cycle, so we have to think about normalization. And so the labor market is tightening, but it's probably not tight yet in this second half of the cycle. Now, this may not be a complete explanation because while there are some items that are looking more normal, like unemployment, and inflation's getting back to that 2% type number on things like the CPI and the personal consumption expenditures, deflator could head back there. We still have some things that don't look normal. The first quarter GDP number did not look normal. And so we're expecting a bounce. I think that's a widely held view. Yet we still have low 10-year bond yields. And we have a lot of talk of Fed tightening, even at the conference here today. So which one is off? Well, let me offer another explanation for what might be going on. There's a book that's titled Scarcity, which I would recommend everybody read. Relatively new work by a number of distinguished economists. And it basically argues that human beings react to scarcity in just about anything the same way. So you might be scarce with money, and you'd be in poverty. We think about that, and I think that's well understood. But you could also be scarce in time. You just don't have enough time to get done what you'd like to get done. And you could also be dealing with scarcity of bandwidth, meaning you don't have the bandwidth to process everything you need to do. And so this is one argument for why I say social programs which might help someone don't get used. You don't have the bandwidth to go pursue them. And so the question I would ask is the problem with all the excess reserves we've created that we don't have enough money or that we don't have enough risk-taking? And if it's the second, which I think is the much more likely answer, why is that? And it may not be that debt is too expensive. It's that debt is too complicated in the current system. And so if we look at non-financial debt as a share of GDP, it has an interesting historical pattern where it stays stable for long periods of time. And so if you think about what drove this up in these two lurches, which are basically the 1980s and then right after the tech boom, the early 2000s, we had some innovation. We had financial innovation in the 1980s. We created new kinds of debt, home equity lending, these type of things. And then we added on technology, which made these items more accessible, easier to file forms, easier to communicate with a bank, and so on. So I'd say this might be some evidence that one of the issues is not that we need more excess reserves or anything of that sort. It's that we can't use the excess reserves we have because the system may just be too complicated. We may be dealing with a bandwidth problem. We're not scarce in money, we're scarce in bandwidth here when we think about policy implications. There are some other explanations for what's gone on. There's been a lot of work and a lot of papers written about this zero-bound concern. Now, the ECB is trying to push that a little bit over in Europe, but I don't think you can get very far because you always have cash. In other words, there seems to be a piece of paper that will give you pretty much zero, which is your dollar bill. So what is the issue with this? Well, the issue is if you have a zero bound that's real, it's hard to get negative real interest rates if your inflation target is low. In other words, there's this developing line of thought that maybe the inflation target itself needs to change. Because you have so many central banks at the zero bound, maybe the inflation target needs to come into question. And so this is why I think you're getting a lot of the academic papers talking about raising the inflation target. I think it's very unlikely that we're going to do that. Instead, I'd say let's think about dealing with the inflation target we have and thinking about the implications of that. And so in medicine, sometimes there are studies that try and find patient zero if there's an outbreak of a disease. What was the original cause? What was the first case? And so maybe it's a bandwidth problem here. Maybe it's an inflation targeting issue. Another explanation might be that policies interact. In other words, there are four main policies that a government could use to impact the economy: monetary policy, fiscal policy, trade policy, and regulatory policy. And recently it seems like monetary policy has been given the burden of getting the economy going almost exclusively. And maybe it's an interaction effect here that is also coming into play when we think about how policy is working and therefore how to normalize policy at this inflection point in the business cycle. But what's clear is we've had very low policy rates. Now the Fed funds rate looks odd on both the X and the Y axis of this chart. So not only is it low, it's at the zero bound, but it's also been that way for longer than it's been other numbers. So it's odd on both the X and the Y axis. And what we worry here is that you're creating a bit of an anchoring problem. In other words, you've not been able to give the economy a big enough kick with just monetary policy. And so when policy normalizes, it's going to be an important event. And so there's a phrase in the markets, 3 steps and a stumble, when you think about, say, stock market reactions to Fed tightening. It's an old rule that says it's not the first Fed rate hike that hurts you, it's the third. Because the things that generate Fed rate hikes are better economic conditions and lower unemployment and good things generally. It's also been phrased sometimes 2 steps before stumble. There's some time. So the issue is the first move here is going to be a big deal because we haven't moved in a very long time. And so it's not clear that we're going to get those 3 steps before a stumble. If we had credible forward guidance, that may help. This has proved tough to achieve, I would argue, meaning the Financial Times did a contest earlier this year. They asked folks to describe forward guidance, and they got some pretty eloquent submissions, pretty good items. The winning one was "we'll see." That was the best description of forward guidance they could come up with. And so if the central bank is trying to make up in time what it can't do in magnitude, what we have is a situation where it's tough to maintain an equilibrium. An equilibrium would generally be defined as the Fed behaving the way the market expects and the market behaving the way the Fed expects. It looks like we have hypersensitivity on both sides right now. And so it's worth asking, where can we go from here if we're maturing in this business cycle? we've added a lot onto the Fed's plate. And their tools may be approaching the point where they've reached their limits. That's one of the reasons to taper. And so uncertainty has created a hypersensitivity to financial developments. And I think this is why in the Fed statement, we keep saying that financial developments, financial conditions matter so much. Because while there's a considerable time between policy action, I don't think there's a considerable time between the market interpretation of a policy action. The market will almost certainly lead the Fed here. So I've used up my time. Why don't I pass the microphone over to some of my colleagues?
This is my turn.
Yep.
Last night at the dinner table, I learned about the dress code of Wyoming State in summertime, and they recommended me not to wear the tie today. But this is my only occasion to be tied up during my whole visit for a week. I bring this more than 8,000 miles away from Tokyo, so therefore maybe it's a good idea to tie it up. And also it's better for me that I looks like a little bit more reliable economist here. Well, this is the latest reading of the GDP. There's a spike. As you may know, we raised the VAT rate from 5% to 8% the first day of April, so therefore there is a windfall last minute buy. Before the annualization, quarter-over-quarter growth was 1.6%, so therefore more than 7% growth. The point is whether this kind of speed, the momentum, upward stream will be sustainable after the second quarter this year. Oops. And this is the long, miserable charts of the Japanese GDP during the last 2 decades. And I was assigned for the economic research for the first time here in 1992. At that time, when I was introduced by the Wall Street Journal in Asia, she gave me a very good nickname, strongest bear in Tokyo City. I was the most bearish economist at that time. No one talk about the deflation. They call it the price destruction positively. Finally, there is some positive dynamics to elevate the level of the productivity in a notorious distribution network in my country. Don't worry about that. But one of the reasons why I'm so pessimistic about this, because maybe people's mindset or behavior of spend money by the household is just pegged with the nominal dynamics rather than real dynamics. For example, at that time, nominal wage rate growth decelerated very sharply. But on the other hand, there is a huge downward pressure in the price, so therefore there is almost no change in the real term wage, regardless of the sharp down in the nominal wage rate. But so therefore the majority of the economists says that don't worry about that. Maybe the real consumption level will be sustainable in a good level, but to tell the truth, the propensity to consume of the Japanese household continued to decrease down until year 2002. Now we are here. Majority of the opinion is very bearish, Japanese economy. I am on the bullish side this time around, but maybe the argument is the other side of the coin. After the VAT hike, maybe there is some inflation, but the wage hike increase is just lagging, so therefore the real income going to decrease again. So therefore maybe from the second quarter you should care about the sluggish consumption. Maybe propensity to consume is going down sharply. 2 decades ago, we did the same argument. They are much more care about the real phenomena. At this time, maybe they are too much worried about the real phenomena, but we should care about the nominal figure. Oops. This is a chart of the Japanese propensity to consume. We are here. From the 1977, the propensity to consume, which means the amount spent by the Japanese household divided by the disposable income was 85.1%, highest record since 1977. Of course, there is a severe sampling bias. We have only 8,000 survey, but still this is something. It is one of the most striking charts I've ever made by myself. Here, this is the timing when we introduced the VAT, and this is the VAT hike, first hike, and here. And we have another data set, including the farmers and fishermen, starting in year 2000. And that was much more striking, 105%. So they spend every penny of the paid wage, and they just liquidate some of the deposit for the consumption in March. So my point is, before worrying about the downward pressure after the VAT hike, it is easier for the Japanese consumers to spend money. The 3% higher the VAT was a catalyzer to spend money. So I'm talking about the inflation expectation. And let me introduce my family story. Nothing but my family story, but I think it is a very eloquent message to you to understand this point. My daughter, born in 1991, and when deflation was started, she was 5 years girl, so therefore ever she could not understand the mechanism of inflation. The price is going down. This is a way for her, a way how to understand the price. So therefore, every time I ask her to urge her to what kind of present would you like to have for next birthday, every time she just delayed the purchase time till the last week. But for the first time this January, she asked me to urge the purchase because she just understands maybe the price is creeping up. This is what I'm talking about. So money illusion, I learned from the giant economist this country just had. In 1928, I remember famous Dr. Irving Fisher published the book titled The Money Illusion. Put it simple, the growth in nominal income is important in deflation during the 1920s in this country. Oops. Maybe time is running, though. Oops. One page back. And the next topic is whether this phenomenon is sustainable. At the end of the day, if there is no sustainable higher wage growth, a little bit higher than the inflation path, it is indispensable for us to keep the reflation track in the future. The left chart is the demand-supply situation of the labor and the capital. Diffusion index means the numbers of the corporation who says we have the excessiveness of the capital labor minus the numbers who says that we have a shortage of the capital labor. The labor side, this is the blue line as indicated labor. The level of the shortageness of the labor is equal to that in the year 2007, the best year of the Koizumi reform age, and also equal to the level of 1988 in the middle of the bubble economy. And also the capital side, very close to down to the zero bound. So therefore, in a total picture, the macro picture, there's a serious shortage of labor, and there's almost no slack in the capital. So therefore, we have highly plausible that we have the inflation gap, not the deflation gap, as estimated by the Cabinet Office economist. So the wage hike rate in the spring is the highest in the last 15 years, regardless of the political pressure from the Abe government. There is the background for the Japanese workers to have the higher wage growth. Mike, how many minutes I have?
You have 7 minutes.
7 minutes. Oops. One caveat, there is some important agenda to talk about the U.S. labor situation, to touch upon the temporary stuff. We have another issue, and this is the real data of hourly earnings year-on-year change, nominal term. And this part is a little brightly colored. This one is simulated. I just put the simple model. If there is no very scarce cyclical unemployed person, I just deleted the structural unemployed person. And if there is a smaller number of the just the cyclical unemployment who can be solved by the larger final demand, That means if there is a tightness of the tighter demand-supply situation, naturally there should some upward pressure in hourly earnings. Up until 2004, 2006 time, there's very clear correlation between the tightness of the labor market and the actual hourly earnings, but suddenly there is a structural break here. We just changed the temporary staffing service law largely in 2004 and 2006, and that was one of the big reasons to push down the wage growth. And if this structure between the labor market demand-supply situation and the wage growth is maintained within the structure we saw, or before the legislative change as of 2004, 2006, today we have more than 3% nominal wage growth. And this gap can be beautifully filled up by the marginal change of a temporary staff. So therefore, whether we will see another elevation of a temporary staff in the labor market in my country is a decisively important factor, whether this inflationary trend will be sustainable or not. But we will change the staffing service law. Again, this is one of the articles, the so-called third LO this time. Just the regulation side, we enlarged the business to employ the temp staff out of 26 just restricted area. So therefore, from now on, every kind of business can employ the temp staff. That may be the downward pressure for the wage, but on the other hand, this law put a mandatory pressure for the dispatcher side. Temporary staffing service company should employ the staff by the permanent basis if this person continue to work to do same job for more than 3 years. So therefore we'll see, but I'm fairly optimistic about the wage trend. Maybe we will see the wage inflation more than 2% within this fiscal year. Oops. Maybe I should lash. One of the reasons why I'm optimistic about the continuous wage inflation is China. China is now, without no doubt, the substitution for the Japanese manufacturers. So therefore, unit labor cost inside Japan is going higher. So therefore, to hollow out to China to establish a manufacturing factory to tap the low-quality labor. That was a mechanism seen in the last decade, but no more. This is the unit labor cost soaring. And I just recalculate the Japanese consumer price index weighted average by the import from China. So therefore, this is the price dynamics of the basket imported from China. At the peak of the deflation, awesome deflation number of minus 25%. Without no doubt, China is the major engine to export the deflationary pressure to Japanese economy. But now it is inflated more than double digit. The Chinese imported goods is inflated at least more than 7 to 8% higher than the general inflation in my country. So therefore, there's no pressure from China. And the second, capital side, this green line is the expected return on investment, the gap between the return on an asset and weighted average cost of capital. And when the expected return is higher, the Japanese corporation just increased the capital expenditure. That worked until the tsunami. After the tsunami, even if the expected marginal return is surging to the historical high, they just stopped capital expenditure, although there is some upturn momentum in the recent reading. And this kind of sluggish capital expenditure could not last longer. And this is the latest quarterly survey by the BOJ Tancom. After the VAT hike, suddenly there's a upward jump in the capital expenditure plan center in the large manufacturers. So therefore, right now, as of May, the annual growth of the capital expenditure is higher than that of year 2007, the year before the Lehman shock. And maybe I should skip some of the charts for the time constraint. And real interest rate going to negative spread. Again, I would like to emphasize upon the mechanism of inflation, deflation, inflation expectation. Finally, the real interest rate in my country is going down in long term. In the United States, in Europe, real long-term interest rate is going up, the other way around. And this is the corporate balance sheet. cash deposit divided by sales is creeping up. A jump after the Lehman shock and jump again after the tsunami. And suppose if under the moderate sustainable inflationary expectation by the corporate management, and suppose this high inefficient cash management is ridiculous, so why don't you push down this ratio up to the down to the level as of year 2007, before the Lehman crisis? 38 trillion yen, 1/4 of the cash and deposit held by the Japanese corporation should go out. And that was equivalent to the 54% of the total capital expenditure of the previous year. So therefore, anything that expected real return from the cash going to negative. So therefore, corporate manager, if they are rational, they should do something. Hire the people, pay more wage, or pay the new machine, or pay some company, go abroad by the direct investment, or share buyback. Any out from the cash is weighted right now under the inflationary pressure. So this is the rebalancing of the financial assets in the household. Left chart, they push down the allocation to the cash and deposit and elevated the risk exposure to the financial assets. Risky asset, here I define the investment trust and domestic equity and foreign currency denominated asset is going up. This person is problematic. This is my client's aggregated number of the flow data of the Japanese private pension up to the end of the last December. They continue to liquidate the foreign currency denominated asset, then continue to sell the domestic equity, they continue to put their money in the cash account, then continue to pile up the exposure in the JGB market. They do not hear me in the last 2 years, although I became bullish about the Japanese, this kind of dynamics in the last 2 years. But by mistake, I just forgot to put the latest quarterly data. Finally, they are thinking about the rebalancing, much more exposed to risky asset. And possibly one of the reasons is one of this important item is the third arrow growth policy package released in June. You may know that the GPIF, the largest institutional investors in the world, government pension investment fund, already set to liquidate the JGB portfolio and into the domestic equity market together with the foreign currency denominated asset day by day, although there is no disclosed data. So therefore, something is happening. So therefore, again, the last remark is please understand there is a generally qualitative nonlinear differences between the deflation and the inflation. I live in a deflated country for 2 decades time, so therefore maybe it's a little bit hard for you to feel the real touch of the deflation. But this is something is going on since last year. So therefore, for the time being, I would like to be in a bullish camp. Thank you very much.
Let's keep our attention in Asia for a while. I will focus my discussion in China. So recently, the media comment on the Chinese economic outlook, mostly they are very pessimistic. There's a lot of talk about hard landing, crash in the property market. This is in stark contrast with the general comment back a few years ago. At that point of time, the comments were more favorable or were more on the positive side. So today, let's see whether we can find some middle ground in between. Oops, I hope I do not turn it off. Okay, so the 4 points I want to make. One, Chinese economic growth has stabilized, but lacks significant upside momentum. While short-term growth rates has declined, medium to long-term rates remain. The third point is that structural reform ultimately is the key to rebalance the Chinese economy and to achieve sustainable growth. But the path should be bumpy. The last point I want to make is that to ensure a smooth transition in rebalancing the economy, China should leverage up central government and how so. At the meantime, they leverage local government and corporation. We'll see why. So the first chart shows that China GDP growth on year-over-year turn and quarter-over-quarter annualized turn. In Q1 this year, China economic growth slowed down to 7.4% on year-over-year basis. That's the lowest pace of growth in 18 months. On sequential basis, the slowdown is even more dramatic, to 5.7 quarter-over-quarter annualized rate. This is way below the 7.5% growth target that the government set for this year. Part of the weakness is expected and planned, as the government tackled overcapacity in some industry sectors, cool down the overheated property market, and carry out anti-corruption campaign. Sorry. Okay. So, for example, the anti-corruption campaign has distorted the order flow for consumption goods from state-owned enterprise and government bodies. Publicly funded purchasing accounts for more than 20% of China's retail sales, and that almost disappeared this year. So it may be a good thing and a healthy development for China in the long run, but inevitably, it has negative impact on short-term growth. So still, the magnitude of the growth slowdown is more than expected and planned. In responding to slower growth, the Chinese government has rolled out a series of mini stimulus since April. When they say mini, that's compared to the trillions of stimulus that they introduced back in 2008 and 2009 in responding to the global financial crisis. The mini stimulus pretty much include extending tax break for small business, speeding up investment in railways, and rebuilding poor urban districts. The PBOC also conducted 3 rounds of selected cuts in reserve requirement ratio over the past few months. So it seems that the growth has stabilized. This is supported by the picked up in Credit Suisse Li Keqiang Momentum Index. By the way, a little bit self-promotion. I helped develop these indicators when I worked at Credit Suisse. So basically, this indicator monitors China's growth momentum by checking high-frequency sectorial indicator like industrial power consumption and long-term credit growth and railroad cargo volumes. By the way, these are the 3 measures Premier Li Keqiang prefer to look at. If you don't trust China's official growth figure, this perhaps is one of the indicators that you can put more faith on. And the growth stabilization is further supported by improvement in purchasing managers' indicators. Publicly funded consumption is still missing, but sequentially, the drag on the economy is getting smaller. Strong sales in autos and consumer electronics also encourage inventory build-up. In addition, the export orders has getting a little bit more momentum after a soft performance in the first quarter. And again, some of you will point it out, China's official export orders, export figures from time to time were distorted by fake export orders between China and Hong Kong. So the next slide, we looked at China's official export figures, excluding Hong Kong, alongside with import data from China's major trading partners. By and large, they match together, which suggests that the recent improvements in Chinese export are more genuine and not inflated by fake export orders. So next week, we will get Q2 GDP release from China. We believe that Q2 GDP will rebound to about 7.8% quarter-over-quarter annualized rate, up from 5.7 in the first quarter. On an annual basis, we believe the government can largely achieve its 7.5% growth target. Oopsie, there's some problem in the slide. You may look at more clearly on your iPad. So while growth has stabilized, it lacks significant upward momentums. So this chart plots purchasing manager indicators from January to June this year, alongside with its 5-year range. You can see that clearly they are mostly on the low end of the 5-year range. There are two reasons for the expectation why we don't expect a very strong pickup in the second half of this year. Number one, the current regime led by President Xi Jinping and Premier Li Keqiang, they seem to focus more on structural reform. Yes, they have rolled out a series of mini stimulus packages to support growth. However, we expect the dose of the stimulus will be just enough to set a floor for the growth in order to facilitate structural reform. The second reason is that the Chinese government is now facing less pressure on the employment front from slowing growth. This chart plots new urban workers alongside with real GDP growth between 2009 and 2013. You can see that employment growth held up pretty well amid slowing economic growth. This also partially reflects the fact that China's aging population labor force is growing slowly and slower and slower. Let's take 2013 as an example. So in 2013, China real GDP growth is 7.7%. And in that year, China created more than 13 million new urban jobs. In other words, each unit of real GDP growth, roughly speaking, support 1.7 new jobs. The employment target for this year is 11 million. If the relationship between growth and between GDP and employment growth that we talk about holds, it will only take 6.5% real GDP growth to achieve the 11 million employment target. This is probably how the Chinese government came up with the 7.5% growth target this year, to add 1 percentage point buffer zone to the 6.5% growth rate that we just calculated. The core problem of China's economy is the desire for investment in the private sector is low, which forcing Beijing to focus more on infrastructure investment. Okay. We can see that back in 2008 and 2009, there's huge pickup of infrastructure investment. This is in responding to the global financial crisis. The Chinese government did it again in late 2011 and early 2012. Why infrastructure investment, by the way, we'll see that in a slide later on, private capital dominate investment in the manufacturing sectors. So why infrastructure investment can help stabilize economic growth, it has created a serious problem on local government debt and shadow banking. And this is exactly where the pessimistic comment came from. This chart shows total credit to GDP ratio, and you can see that it shot up sharply to 180% over GDP in Q4 2013. This is up from less than 150% in Q1 2011. And you can see that a large chunk of the increase was created by shadow banking. The traditional bank loan increase was more benign during this period. Specifically, Charles Frank increased from less than 5% of GDP in 2010 to more than 20% of GDP in the first quarter this year. However, their lending structure, fundamentally, they are long-footed. They tend to lend to long-term projects, but their francs have to be low over, early 1.5 and 2 years. And you can see that from the pie chart, about 70% of the Charles Frank lend to highly leveraged sectors, real estate, local government financing vehicles, and this is much higher than the traditional on the balance sheet credit. It's less than 40%. In the first half of this year, there are reported 63 billion default in China from the Charles Franks. And with the property market is cooling, transaction volume is shrinking, that will increase the Charles Frank repayment risk. Credit Suisse estimate the next peak of Charles Frank repayment will happen in late this year and early next year. And as I just mentioned before, there are reported 63 billion default in the first half of this year. We will expect more negative news flows coming out late this year and early next year. Okay, so this chart shows BIS estimate for credit to GDP gap and debt service ratio relative to trends for major emerging market countries. You see that clearly China has the highest credit to GDP gap and debt service ratio. So how do we do with that? How do we do with these credit problems? So one thing is not all of the sectors in the economy, they are highly leveraged. And you can see that clearly central government, they have less debt to GDP, and they run a fiscal surplus. And eventually, we expect that the central government will step in, inject capital to settle the local government debt issues. However, the central government can take two different approaches. They can either inject capital to local government, or they can inject capital to banks. So, however, they will carry different implications. Injecting capital to local government means that taking preemptive approach to prevent a crisis. Injecting capital to banks means that's going to clean up all the mess after the crisis. We think that it is increasingly likely that the government is going to take the second approach to teach local government a lesson in an effort to eliminate moral hazards. The central bank has the willingness and fiscal strength to settle the local government debt issue, but it may well let the situation deteriorate further before stepping in. And on the other hand, the shoot up in the credit to non-financial sectors is really concentrated in the corporate sectors. Household leverage situation is more benign. Actually, it's very low if you compare to the US situation. And there's a lot of room for China, in order to rebalance the economy from export and investment-led to consumption-led to leverage up the household, and while leveraging up the corporations. This is especially true. It's much harder to boost Chinese economic growth with each unit of actual credits. And structural reform is the key to deliver a more sustainable growth. These are the reform items listed by the party's third plenary session held in November last year. So given the time limit, I'm not going to go through all of them. I would just make a comment on from the first item, open up the service sector to private investment. So this chart shows the ratio of private to public fixed investment in manufacturing sectors and for selected service sectors. So the one on the top clearly is on the manufacturing sector. It's almost 8-to-1. A private investment over 1 unit of government investment in the manufacturing sector. And this is exactly why China can successfully to build itself into a world factory. China opened up manufacturing sector to private capital early on, back in early 1980, and basically private investment and the private manufacturing, they have more efficiency, and that's how China become a world factory. But the same thing cannot be said for the service sector, as you can see that for IT, finance, leasing and business service, and tax service, mostly they are below 1, the ratio. And this is exactly the direction that the government tried to work on to break the monopoly of the state capital and introduce more private investment. And also, we know that service sector, they are more labor intensive. It's also good for China's employment pictures. And that's exactly, where the opportunities is for the next decade. I'll stop here.
Rather than really cover the rest of the world, I'm going to give you a framework to think about how the world works together. And I think the comment that Don made is completely accurate that, since the 1990s, we've had technology, globalization, a shock from low-income workers becoming available after the wall fell. All of this changed the world, and we're truly in a global economy now. And the way I think of that is I think of the United States in 1980, and I think of the world. And as I think of that, the United States is the Northeast. It's the financial center, it's the healthcare, it's the insurance, it's the suburbs. It's where doctors, lawyers, Indian chiefs work. There's no unemployment problem there relative to the rest of the world economy, and recessions are not real economic events, they're financial events. I think of Europe as the industrial Midwest, as Detroit, Chicago. They're the old technology. They're the sector that's being challenged by the new the new manufacturing sector, Asia, specifically China. And then the rest of the world are the commodities producers which feed the Chinese factory floor. Now, I look at the world that way because I work for a commodities trading operation. We have a global view. But I also look at it that way because when I started on the street in 1980, I worked for Gary Schilling, and we called recessions every year. And if you're going to look for a recession, you look on the factory floor, because recessions don't start in the suburbs. So my focus now is mostly on Asia, and particularly on China, where I travel 3 to 4 times a year. As I look at the United States, and I look at the financial sector, and I look at the suburbs, the biggest challenge to the United States is Lehman. In the United States, we have closely held wealth. That's not unique to the United States. It's true around the world, and it's not a good thing or a bad thing. It's an is thing. It just is. And if you're going to have highly concentrated wealth, then you have to have a deep, very, very effective financial intermediation system to redistribute money from those that have it to those that are going to use it most effectively, because they're usually not the same people. People get rich by having a good idea when they're young and staying with that, but they usually don't have a second one, so you redistribute wealth through the financial markets to find better opportunities for yield. Well, we had that system right up until September 15th, 2008. And the day that Lehman died, trust died, not just in the United States, but globally. And now people would rather take zero than take a risk on what would have been acceptable investment opportunities before Lehman and are no longer seen that way. And we think basically you're in an environment where you have slower than normal growth, lower than normal interest rates, lower than normal inflation, until that trust is reestablished. And we're 6 years away from the downturn. Figure 10 at a minimum before you're there, and I really don't know the number, but I know it's not 7. Let's put it that way. Europe, well, Europe's the industrial Midwest. It's the Detroit to Chicago. The good news is that Northern Europe's doing relatively well. The bad news is that the periphery is not. In all of the periphery, and that includes France, the number one industry is tourism. And it's tourism because they're not doing very well in manufacturing. And that's kind of the way the north and the south of the United States were in the 1950s, when manufacturing wasn't in the south. So it had lower cost workers and tourism as its main attraction until finally jobs moved. Well, when the Germans start putting jobs in the periphery, then Europe will recover strongly. Until then, they're stuck in the same situation that we were in a couple years ago, where their banks are undercapitalized, there's going to be a huge regulatory oversight, there's going to be a strong demand for capital growth, and so there's not going to be a lot of fresh lending, and therefore neither a lot of growth nor a lot of inflation. Now, is there going to be another recession? They start closer to the edge than the United States did. We're bouncing along at 2% something because we've got 0.8% population growth. They're bouncing along at 1% something because they have zero population growth. So I see them as kind of caught in the same slow growth, low inflation trap that we've been in, and I'm not really sure what the financial policy is going to be that breaks them out of that, since they don't have either coordinated financial policies or really a strong monetary policy because of the problems of separated financial markets. I'm not going to give them a strong growth impetus. So that leaves us on the factory floor in Asia, in essentially the Sun Belt, shall we say, where most of the jobs are gravitating to, where most of the investments gravitating to, and where slow growth is a number like 5% and strong growth is a number like 10%. Well, China right now says it's growing 7.5%. I don't believe it. You know, I mean, I'm not saying that that they're in a recession, but if I had to guess, I would say that growth on the coast of China, which is where about 60% of the GDP is, the number is somewhere between 4 and 5. And the number inland, where about 40% of the GDP is, could be 10, could be 10 plus. And the difference between those two is that on the coast, they're in a classic middle income trap. They've gone as far as they can go with cheap labor, and they need new institutions. They need financial services, they need health care, they need insurance, they need lots of institutions which simply don't exist in depth in China today, and they're going to have to build them. And that's the next phase. If they accomplish that, they'll break out of the middle income trap, just like Taiwan did, just like South Korea did, but it doesn't happen in 1 year. Meanwhile, they have a difference over Korea and Taiwan in that when Korea and Taiwan hit their middle income trap, Seoul was all of the South Korean economy, and Taipei was all of the Taiwanese economy. China has the option of having continental growth to the west, the way the United States did in the late 1800s, and that's what they're doing. They're building rails, building infrastructure, shoving growth further and further into the country, partly for growth, partly because the pollution problem is so bad in Beijing, south all the way almost to Wuhan, that, I mean, you literally cannot breathe. I was there 3 months ago, and the day I got there, the reading was 50 on the meter, which is pretty good. You know, 100's kind of a bad day. The next day it was 700. I mean, that's not a very good number. That's like 4 packs of cigarettes a day. So they're moving industry. They're doing all these things as quickly as they can. I think the Chinese have a plan. I think they have some of the most capable politicians, really management, because they're not really politicians. They're not elected by any means. They're not beholding to any public in that sense. They have managers. It's run like a corporation. The problem is you can be the best, baseball team in the world, but if you're asked to play football, how well are you going to do? And that's the problem for China right now. They've been surviving on capital investment, a very infrastructure-intensive growth model, and now that's kind of played out. And they can keep doing that in the West, but they can't do it on the coast. So the question is, what is their next card? And my guess is that their next card is slower growth than most people expect, and that backs up to slower growth in the commodities world. Now, a lot of people are going to say, oh, you mean China's going to crash? No, it's not a problem for China at all. Chinese debt is entirely Chinese-owned. The party controls the country absolutely. They'll do what they need to do to maintain power. The party wakes up every morning and asks one question: what do we have to do to be in power tomorrow? If that means stimulus, you stimulate. If that means no stimulus, you don't stimulate. There's something of a civil war or a purge going on in the party. The party discovered with Bo Xilai that there was more risk from inside the party than there was from outside. And you're seeing a vetting of huge sectors of the economy, almost everybody in the energy sector, large numbers of people in the railway sector, large numbers of people in the telecommunications sector have lost their positions. One of the top military officials went out last week. This not only clears out the adversaries for Xi Jinping, this makes huge opportunities. And now that he takes over those industries, has the ability to distribute those jobs and the benefits from those jobs to the people who are with him. So I think he's going to be successful. I just think it's going to be very bumpy and ragged. The problem is not for China. The problem is for the people who are supplying China, for Chile and Argentina and Brazil and Australia, Indonesia, a large number of commodities producers around the world. If they have volatility, they don't have all of their debt in their own countries. They don't have low interest rates. They don't have low debt levels. So I think that's where the problem is. And that problem backs up to Japan and European banks, and not to the United States at all, because we're not involved in that. So as I look for the next recession, and there will be a next recession, I don't think in the next 18 months, but someplace out there there'll be a recession. I look in Asia, and particularly in Asia, ex-Japan, ex-China, for the weakness. Now, very, very quickly, there's a lot of problems out there in the world. We gave a seminar in London, and we talked about the Ukraine. And I think the very, very short version of the Ukraine is that Putin took Crimea, which is what he wanted because it's his military base. And now he's going to wait to see how much money Americans and Europeans will put into the Ukraine that he gets to take next year. Because if you think about all the money that goes into the Ukraine, it all goes to Russia. It either goes to pay for energy that they already bought, or it will ultimately end up in the export markets in Russia. The Middle East. My wife is Iranian. I follow Middle Eastern politics extremely closely. And I think what you're seeing is the breakup of Iraq into what Iraq was before the British set the borders in World War I. You'll end up with, there are about 30 million people in Iraq. You'll end up with a Kurdish north of about 5 million. In fact, the Kurdish government broke away from the Baghdadi government today, took over oil fields and is forming their own government. You'll end up with about 6 million Sunni, whether it's ISIS or some other groups in charge, I don't know. They'll probably, over time, join with Jordan and Syria and have a large, 30 million population of Sunnis living in an area with no oil. And you won't care about them any more than you care about Syria today. And then you'll end up with about 15 to 20 million Iraqis, Shia, who have oil, about 5/6 of Iraq's oil, living in the south. And the question is, how will they interact with the Iranian government? A lot of people think that Iran will control Baghdad. I think it's the other way around, because the bottom line is Iraq, at full production, will produce about 3 times as much oil as Iran and have about 1/4 of the population. So they're going to be much more the Saudi Arabia to Iran than the other way around. The last one I'd like to talk about briefly is Argentina. Argentina is a basket case. It's probably going to default again. It's been seeking ways out. The scariest way out for Argentina is that they do what the Russians did after the Ukraine, when all of a sudden the natural gas flows were risked. What did the Soviet Union do? They turned to China, and they signed a $300 billion natural gas pact. Who is Argentina turning to right now? They're turning to China. They sell all their soybeans to China now. They're looking for a long-term financing deal. If they get it, Argentina has huge potential. They have the 4th largest shale opportunities on the planet. They took over Repsol from YPF because they weren't getting the investment. They cut a deal with Chevron to make the investment. They've given money back to Repsol to get them back into Argentina. They have a huge opportunity in shale, but I doubt it's in time to get the Kirchner Associates reelected. Elsewhere in Latin America, there's a lot of fear about Rousseff being bumped out now after a 7-1 loss in the World Cup. That may be the final straw, I'm not sure. That's my kind of around the world as quick as I can do it. We'll leave it open for questions.
All right. Thank you very much. It has been, let's thank all the panelists. It's been a very long day, so I'm going to withhold the moderator's privilege of asking the first question and just turn to the audience, and we'll do a couple of questions, and anybody looking for a World Cup prediction from the panel can probably wait until afterwards at the cocktail party. But do we have a question out there? everybody. Either I'm not seeing it or we're all ready to go.
That's what happens when you get between drinks.
Between drinks and Rolls Royces. Well, let me just conclude this by asking one quick question of all of you. These people here, for the most part, with the exception of Kozo, go to sleep in America every night. They may or may not be exposed to various parts of the world. So if each of you, in 2 sentences, just very quickly, as they lay their heads down on their pillow, what's the boogeyman under the bed that they should most worry about? Don?
So just very quickly, I would say that we have to think again about that interaction between different policies. I said there were 4 policies that I would watch: monetary policy, fiscal policy, trade policy, and regulatory policy. And while I wouldn't make it the base case, there is an interaction between monetary policy and the fiscal side that I think deserves attention. The Fed has laid out a very clear plan. How will that be perceived in Congress, and will there be bills, even if they don't pass, that say are going to jeopardize the Fed's ability to pay interest on excess reserves? If that's the plan and it's going to be put in the press as something that's going to cost money, what happens then? So I think the interaction effects between those 4 policies is where I'd look.
Kozo?
Well, without no doubt, the expected outcome caused by the unwinding of the QE by the key currency nation United States, no one could tell exactly what's going on, what's kind of the effect. The only maybe historical record is way back to the 1937, 1938, but no one knows about the expected outcome in the modern history. So therefore, it was scary. The other day, just a quick observation, just for experimental approach, I just gauged the sensitivity of the risk premium of every different risk asset vis-a-vis marginal change of the balance sheet size of the Federal Reserve. That was y-axis. And x-axis is a degree of so-called the causality. So which exactly the scattered around which risk asset in the world is most sensitively inflated during the QE time, started from QE1, and which asset has the probably the highest causality between the quantitative easing in the past. First, most correlated ones is the WTI. The second is Bovespa, the index of the Brazilian equity. The third is the Shanghai A-class. So therefore, maybe that story is just correlated with the observation of the Michael Jury. So, but we just necessarily, I am not means that maybe we will see the totally the opposite side will happen. So therefore, the very unclear what's going on. But we'll see.
Henry.
Okay, so the risks that I care about, Don already said that, so I said something else. So I just mentioned that the Chinese government, they has the intention to teach local government a lesson. And the Chinese government did that last year. They let the overnight interest rate increase from 3-4% to 14-15% to teach the aggressive lenders. And they did it again early this year. They let Chinese IMB depreciate to teach speculator a lessons. So the risk here is that's miscalculation. So on the way, they teach the local government lesson. There will be a downward spiral, which is out of control of the Chinese government. That's the risk I worry about on the Chinese economy.
And Michael.
I'm going to stick with the one that Koza just talked about. It is the driving force of economic growth in the early part of the millennium was the commodities boom associated with the opening of China. I think the commodities super cycle is now over, and I think the greatest risk is that the commodities producers, even with a moderation of growth in China, will be exposed, and that means Latin America, Argentina, etc., Indonesia, Malaysia, as suppliers to China, and that there would be, in essence, a second Asian crisis, a banking crisis.
And on that cheerful note, let's thank Michael Drury, Henry Mo, Kozo Koide, and Don Rissmiller. And thank you all for today. David.
And thank you to Mike McKee for your coverage and for moderating this panel. A quick 2 minutes. all speakers, sponsors, thank you very much. All of you who sat through the day. We hope you enjoy it, and we hope to see you again here on July the 10th in Salt Lake City on Monday morning. And we can tell you that the GIC meeting with the Banque de France in Paris is March 23rd, and that date is now set. And the Banque de France, the Central Bank of France, will be our host venue for that conference. So if you want to sample the escargot from someplace other than Jackson Hole, you're invited. Let me add just one other thing. At the very end, Mike in the World Tour discussed geopolitical risk. You think about the themes that we've had with 3 entrepreneurial stories. We discussed state and local government debt, and we talked about Federal Reserve policy, and we did a lot of economic outlook, and we spent 10 minutes on geopolitical risk. Michael, in the economy of time, you covered the world. I was writing it down, and I thought, gee, Africa wasn't mentioned. We should add it to the list. The highland countries in Asia, which are now dismembering again, we should add it to the list. We could do an entire morning on the Shia-Sunni schism in 1,000 Years' War. We could add it to the list, and this list goes on and on. So one could say there is a subject of deep influence for us to think about every time we turn on the news, and how much we took for granted in all of our conversation all day about the wonderful safety of the freedoms we enjoy and how high the risk is to them. 7 to 9 tonight for the party. Thank you very much.